Hey, it's Eric with Jazz Wealth Managers. Big question that we get a lot, especially in a volatile market, is how should I be investing? Or maybe I should, even a statement where people want to say, well, I want to pull some money off the table. Well, when the market's falling is not always the best time to pull money off the table because you're basically taking your losses. Instead, you want to look at some other opportunities. It's a lot for another video. But the idea with this is that we really need to figure out how much risk you should be taking. So that's something that you need to really know when it comes to your retirement plan. And I want to show you how we're looking at that in Nest Egg. So what we're talking about here is old Louis and Lucille. So with Louis and Lucille, 59 and 58 years old, you know, they're getting close to retirement years. Going to need a little bit of money in retirement, $5,500 a year. As far as savings go, they've got quite a bit that they're doing here with their savings. Income, they've got, solid salaries. He makes 85, she makes 75. They'll have their Social Security. But they're actually retiring. You know, we've got that at 58. We're going to say they're going to retire at 60. Why are we going to say that they're going to retire already? So we're going to put that at 60 right there. So now we've got them retiring at 60 years old. So they're going to be needing $4,000 a month. As far as their net worth goes, this is what we want to look at because we've got their investments. Louis and Lucille have saved quite a bit of money. They've done a great job for themselves. They've got $140,000 in a Roth. Got an old 401k with 812, old 401k here with 1.16, and then a taxable account with 105. The thing about it is we want to go and we want to see what they're doing if they're on track for retirement. That's the big thing. Are you on track for retirement? And if so, holy smokes, they're not just on track for retirement. It's looking right here. 100% probability of success. They're beyond on track for retirement. They're going to be set. They're projected to leave $4.735 million to their children or whoever they are leaving this money to. So that's a lot of money. They've got a lot going on here. But the thing about it is that Louis and Lucille, let's go over here to the investment tab and see. They're 72% stocks, 28% more fixed income bond market. And so they've got a lot going on, but do they need to be taking this much risk? Well, let's go ahead and take a look over here. Let's look at if we bump them down to a 35% stocks, 65%. So more of a conservative take. The thing about it is look right here. Standard deviation, that is 12.1%. That's what that's showing. It's smaller numbers, so if you can't see it, I'll read it to you there. So that means that they're deviating 12.1% sometimes. So that gives you an idea that it's going to be a lot more volatile. There's going to be a lot more ups and downs in a portfolio like this versus over here, you're only at 6.8%. So literally cutting that almost in half. Now, you're not going to have as much of a return if you were to pull back risk. But I want to look at this and really say, okay, so we go over here to the retirement tab. We'll make some adjustments. Let's see if they go into the conservative fund, what that's going to do for them. So right here, what that does, they're still at 100% probability of success. Now, they are going to lose a lot of money at the end of the plan. The reason for that is because of the fact that, you're taking a lot of long-term earnings off the table. But, if you're in a position where you're retired and you just can't stomach the long-term risk, and maybe you don't need to be taking that risk, that's what we're looking at with this plan. So many people in a volatile market, they just can't handle the risk. And maybe you're in one of those positions where you shouldn't be taking that much risk in the first place. So then what we want to look at is, well, how exactly are we going to tell Louis and Lucille to adjust their portfolio? Well, if they're with us, we can do it in-house, customized, and build their portfolio out to how we see fit. But for this scenario, what we're looking at right here is just telling them, specifically your U.S. equities, you're $470,000 into the, too far into U.S. equities. How am I supposed to say this? I'm trying to get the words out. But basically, they have too much money in U.S. equities. They need to drop that by about $470,000. Real estate, right here, you got over $40,000 or about $40,000 that they need to drop down. You can go into cash. Now, most people were not saying, hey, put a lot of money in cash, but you know what? They can do it. And it's okay if they have a little bit here. International equities, definitely overexposed. They need a little bit more bonds, some out of emerging markets and more in international bonds. So this gives you a breakdown of what we are looking at when it comes to something like this to really find out what the exact retirement risk you need, or exact risk you need to be taking for retirement. So taking a look at all of this and what's going on, maybe take a look at your portfolio. Start asking yourself questions such as, am I taking too much risk? Am I on track for retirement with where I am? If you're working with a planner, ask them those questions. If you're not working with one, we're happy to help you out. We can get you into Nest Egg, get you set up, make sure that you're taking the right amount of risk for your goals. If you like this video, if you would, be sure to hit the like button. Hit the subscribe button too. Leave us a comment below. Let us know what you want us to talk about next. Thanks for watching.